Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us remotely is Steve Sosnick. He's a Chief Strategist over Interactive Brokers. We're going to take a look at what you need to be on the lookout for on Options Expiration Fridays. Thank you so much, Steve, for joining us. And for our first monthly hit together, we certainly are in the midst of unprecedented markets.
Oh, clearly. It's a pleasure to be joining you, Jill, and I appreciate the invite to do so. Yeah, there's, what's the old Chinese proverb? May you live in interesting times. We are doing that.
We certainly are.
The good thing about options is it's a good way to play interesting times.
All right. Let's take a look at April options expiration news on our first slide here. As you said before, we are living in interesting times. Plenty of headlines to take a look at today.
Oh, yeah, no question. I mean, we certainly we're off to the races this morning. The markets love the idea of Gilead's new COVID-19 treatment. I think I'm a little less optimistic that this is the end game because when I read more about it, it's delivered intravenously in a hospital. I don't think anybody wants to get to the point where they can receive that drug. But of course, anything that lowers the mortality and the need for a hospital stay or ventilators is certainly a good thing. I think people responded generally favorably to the opening up America type of idea that the president relayed yesterday. Again, I'm a little more muted in my optimism about that because I think it was certainly good to get a framework for where to proceed. I think there's a lot of unsaid stuff there. It's really still up to the state governors. But the fact that we have a federal framework is good. On the downside, though, the China GDP numbers were pretty rotten. It was down about 6.8%, which is pretty much unprecedentedly bad for recent experience out of China, and does not bode well for the U.S. When our numbers start to come out. And the final thing that I would say is, though, with all the good news on the COVID front, that actually puts a bit of a damper on what had been the trade that had been working best, which I would call the stay-at-home trade. And that is very much, that's been the way that people have been playing this from the positive side. Buying up names like Amazon or Netflix, or which are basically at all-time highs despite the lousy market environment that we've seen most of the past couple of weeks. Other things like Microsoft benefit, Apple benefit, Walmart. These are the type of names that we're seeing sell off a little bit today. I felt that the trade was getting very crowded. And when trades get too crowded, it doesn't take much to take a little shine off them. Though I will say that trade has still worked very well for the better part of the last month or so.
All right, let's move along to our next slide here. And this is not just for April Options Expiration Friday. This is what you look for each cycle that we go through. That's correct.
I've spent, many decades. I was a professional market maker, options market maker, and these are the type of ways that I would approach an expiration Friday, a monthly. In the old days it was monthly, and now of course it's weekly. But what I would be looking for now is the type of thing that we see today is the type of movement that people love to see if you're long options on expiration. And what you want to be doing if you're the trader or looking to enter a position, how to trade on an expiration, you want to be looking for the strikes that have relatively large volume and relatively large open interest. And the example that I've been looking at today is QQQ, which is certainly a market bellwether with great option volume and very tight spreads, very liquid markets. So that to me is one of the best places to look. Coming into today, the open interest, which is always reported a day late, that's just the nature of the beast. The clearinghouses tally up all the net longs and shorts at the end of the day, and that information is provided on a one-day lag. We see that most of the open interest was concentrated around the 210 strike and the 215 strike and the 220 strike. Markets tend to gravitate toward the big numbers. Even though we have dollar strikes, it's sort of the mentality still exists in the zeros and the fives. And today, the 215 strike was very much in play. And let me walk through that a little bit with how some options valuation and option trading gets involved. we don't really know who's behind the open interest there. So let's focus on the 215 line, where there was about 39,000 open interest in the calls and about just under 20,000 open interest in the puts. So that's pretty substantial. We're talking about just under 60,000 contracts coming in, and the volume that I'm seeing at this point in the day is we've traded about 29,000 of those 215 calls already. If you're long options today, this was what you loved, particularly if you were long what were out of the money calls in QQQ, and then we opened high 216 and basically just under 216 on the opening, traded up a little bit, then traded down through the strike, then back up and then down again. That is the type of movement that option traders salivate for. And the reason for that comes back to the options concept called gamma. And gamma, I won't make this too technical, gamma is the change in delta that you get as for each move in the underlying stock. At any given point, the delta is more or less the stock equivalent that you are long and short, and that number changes based on the underlying price of the stock. So let's say in the example of the 215 calls, at the end of the day yesterday, they had a very low delta because they were out of the money. When trading started today, they had a fairly high delta because they were in the money. And then, so what a dynamic trader would be doing, and most professionals do hedge dynamically, so that's really the dynamic that you see in the market. If you were long those calls, you didn't really have much delta to them. Then you woke up this morning, trading started, they're in the money. If you're a hedger, you sell the delta, and the gamma has created that new long delta position. Then we went back through the strike. Now you're short because the delta has changed thanks to gamma. Now you want to cover that short. We went back up through the strike. You want to put that short back out again. All this is keeping you net flat, but you're trading in the ETF to keep your position hedged. That's the sort of stuff that option traders love when they're long. The flip side is if you're short, what do? And I think that's why we saw such a sharp move on the upside this morning, because you had futures options expire, and those who might have been short those futures options don't have the luxury of deciding whether to hedge or not. They pretty much have one shot on the open, and markets look strong. A lot of people had to kind of buy them up and hedge to cover their now short positions, those who were long the calls. And so you saw that kind of violent move on the open that then came off a bit as we went through. This is the type of hedging that we see. And this is why we look to the strikes that tend to have big open interest and high volume, because that's where sort of action begets action. And what tends to happen is we don't know who's long or short these. It's impossible to know the character of who's long and short. The exchanges don't, the clearinghouses don't release that, and for good reason. So we only can guess whether the people who are more likely to hedge dynamically are long or short the options. But today, we see that there was plenty of action around the 215 level, which paid off terrifically for those who were long options at the 215 strike. And now that we've sort of settled back a bit, I would still keep an eye on the 215 level, or if we sold off sharply today, I would look at the 210 level, because down there, you're looking at just about 90,000 open interest coming into today, and still good volume. There's actually been over 20,000 of the expiring 210 puts that have traded. So somebody's betting out there that we could take another leg lower. These are the type of dynamics that option traders are looking for as we set up into expiration. And hopefully this is the type of thing that our listeners can start to use that framework to get a better understanding of what's going on in options expiration related trading.
And this is why it always pays to think and trade like a market maker. Steve, going forward into May expiration, it's going to come up quicker than we even realize. What are some of the dynamics that you're going to be taking a look at in the market?
Well, we basically have earnings season to get through, and that is always a kind of a wacky one for options traders as well, because and this one is probably going to be as difficult of an earnings season, both for whether you trade the options or just equities. It's going to be a tricky season because we don't know what to expect. Right now, we haven't had a ton of results. We've had the banks, which traded well, but for the most part, but had to really increase their loan loss reserves, and it turns out that may not even be enough. So that put a definite damper on a lot of economic sentiment. On the flip side, Procter and Gamble, kind of unsurprisingly, did really well because people have run to the stores to stock up on their type of stuff. But what does this mean as we go forward, particularly to, let's call them the stay-at-home stocks or the sort of the mega caps that dominate NDX? We're going to start to hear from some of those between now and May expiration. Microsoft has certainly gotten a bump. We use Microsoft Teams. I like it, but I don't know who's paying for that. I think that's my company, but has that translated into more money for Microsoft? Is Amazon is certainly busy. How is that translated into profitability? Are they selling a lot but not converting that to profits? That's going to be something interesting to watch. Apple, of course, is always such a big bellwether. So those are just the biggest. But remember again that you're going to see a lot of movement, let's say in Qs or NDX around earnings, because you really have about six different companies that dominate about 50% of the market cap, and when their earnings come out, they can have a profound effect on where the major indices go.
All right, Steve, great to have you with us. Thanks so much for joining on Trade Talks.
My pleasure, Jill.
All right, and thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.